Are we ready to dive further into business valuations? So this is the second lens of business valuations where we are going to be diving into the market valuation. If you have not checked out the overview video of all three of the valuation lenses, I highly recommend going and doing so. And then the last video I covered owner's utility lens. I'm going to do a quick little synopsis on that as how it relates to the market valuation. But if you wanted to go in and get the deeper dive, go check that video out. So the market valuation lens is based on these 4 KPIs. And the way to think about the market valuation lens is regardless of the buyer in the upper middle market, we are going to be using the normalized EBITDA, the multiple, net debt, and working capital. And those are going to be 4 KPIs that are important regardless whether it's an ESOP that you eventually do or a private equity sale or a management buyout or a strategic buyer. These are 4 KPIs regardless of selling. Again, if we want to measure and monitor the valuation of our company in the marketplace, regardless of the buyer, we can always be looking at this lens, because why that's important is if you got an out of the blue offer and someone says, I'm willing to give you 30 million bucks for your business. Well, what does that mean as it relates to an ESOP, private equity, third party sale, etc.? And that out of the blue offer is going to be the strategic transactional value that we're going to use against the market valuation to see if there's a premium, and then how that relates to your owner's utility lens. So before I jump into explaining each one of these 4 KPIs in great detail and how they generate this flywheel effect of creating more value, I want to just orient us again. So the whole point of doing this is so we can have a business that provides us the freedom of time, cash, and wealth, regardless of whether we own, scale, or sell the company. The goal is optionality. That is what I think independence is. And we're trying to reach independence escape velocity. And escape velocity is when we are taking our time and we're investing it, we're taking our time through work as we're decoupling our work and we're generating cash flow, investing that cash flow into wealth generating assets like our company, so we can provide income that frees up our time. This is this momentum and this flywheel. So eventually we can create escape velocity, where up here we have decoupled our cash flow from our time, and we have the ability to transition our wealth, whether it's the equity in the business or other assets. Regardless, we will still be free. That's the whole point. And so there's this 3 phases of the Independence by Design framework, and there's an owner's playbook tied to this, where we're trying to deal with the time, cash flow, and wealth constraints to open up that bottleneck and making sure that we're using our priorities and our time and money in a way that's actually generating momentum towards that escape velocity. What we are working on as it relates to business valuations and why understanding them is so important is because the first module of the framework is expand knowledge, which we have to understand the game of ownership. It is impossible to play the game of capitalism and ownership and be in the boardroom if we do not understand valuations and what creates value. Because if we're making bets with our time and other people's time, all of our people and all the payroll that we have and our money reinvesting into projects, what return is it going to generate on the equity, and what potential for future cash flow is that going to generate? Which is why I created these 3 lenses of the business valuations. And as I said, there's a video already about this owner's utility lens. Go check that out if you have not. And we're going to be talking about the 4 KPIs in the market valuation. And this one is a specific buyer, where there's a unique deal structure with a specific set of circumstances that is going to, hopefully you're going to have a lens to say, okay, well, is that a premium on all of the other options that I have in the marketplace? And then how does that impact my owner's utility lens of what I want out of my freedom of my time and my cash flow and my target net worth? That's why we have to start here. So I'm just going to orient us again before jumping into the 4 KPIs. What's your company worth for you? The goal is that we're double clicking on that time, that what role do you want in the business and how do you want to decouple yourself from that time? So right here, this is just, again, planting the seed for the clarified goals module, which you can check that out on the newsletter in the online academy. And then we have, and how we want to, go back to the time. We want to be decoupling our job, so the W-2 income, and that's where this cash flow comes into play, because what we're doing is we are increasing our ownership distributions. And by increasing those distributions and the predictability of those distributions, we're actually increasing the value of the company. So that then bleeds into our wealth. And that's why this whole commingled mess that we are in as a business owner and operator, we're trying to say, what is this company worth to you? And what I talked about in the owner's utility lens is we highlighted the discounted cash flow valuation. So the discounted cash flow is what we're doing. And again, I'm just going to fly by this because you can go back and watch the other video, is we are going to discount this stream of cash flow to today based on a risk profile to say, what is the risk of those future cash flows? So here, what we're doing is we're taking 500 grand, then 750, then $1 million in owner's distributions. So these are after working capital, debt, taxes, and reinvestment. What is available for you? Which the point is to get clarity of those distributions and make them more predictable for you. But by doing that, we are also increasing the valuation of the company, because what we're doing is we're actually taking this discount rate and we're shrinking it. So we want to shrink that down to 20 or 15%, and that will actually increase the valuation of the company because we have more predictability of the free cash flow. So what we did here in the discounted cash flow is we took the present value of those distributions, which is these distributions, we brought them to today using that discount rate of 25%, which led us to this 2.6 million, 2.66. And then what we did is we took the present value of the terminant value. So that's where when you take this last year, the company's not going to disappear. So you're going to capture all of this cash flow yourself, but then what would it be worth at that point in time? And that's where we take the multiple and we take the multiple of earnings. So we're going to take multiple, which we're going to get into in this video, as well as then the earnings, which is that normalized EBITDA. And then we would discount all of that. So that dollar amount to today based on that discount rate. So that's where we get this total right here of the 9.2 million bucks, because we were taking the 2.66 plus the 6.55 equaling the 9.2. So this is all about forecasting out owners' distributions and then bringing it back to today based on that rate, which I call it quantifying the stomach ache. Well, I can't see into the future. Well, then no one else can. So the more we have visibility into the future and the more confidence we have, the more we're reducing that percentage and the more we're increasing the value of the company. So you can see here with that 25%, that total is 9.22. And then with the Rockin Times, we took a 15% discount rate, so that it's the same stream of cash flows here, everybody. But then what we're doing is we have a smaller discount rate because we have more confidence, and that takes and just increases that number, so which is the stream of cash flows, to the present value, and then also taking the present value of that dollar amount at the end. What would it be worth at that point in time in 2029? So go back and watch the discounted cash flow and the owner's utility material if you want more information on that. It's all about forecasting out cash, actual cash, not gross profit, not net income, like actual owner's distributions. But when we look at the market and we think, and we're talking about investment bankers, or we're looking at, ranges of multiples from our industry association, and we're talking to our friends at our conferences, everyone's using these numbers of the normalized EBITDA and the multiple. And there are all this ambiguity around it. I'm going to try and unpack all that, demystify it, so you can understand like what's actually going on inside of each of these numbers. Because yes, that we start with the owner's utility lens because you care about cash and decoupling your time. And we're going to be able to mathematically show the forecasted cash flow and the discounted cash flow. But if we wanted to then go talk to an investment banker about an ESOP or a private equity firm, or just if we get an out of the blue offer, we want to synthesize it against what's the rest of the market using, because they don't have your structure. So like we have to take outside of your structure, which might be a C Corp, LLC. You might have your own tax games that you're playing with, debt or tax games as far as it relates to accounting, or you have a different capital structure and how you're using debt. All that has to be stripped away to say, what's the earning potential of this company, which is where these 4 KPIs come from. So I'm going to give a high-level overview of each of these, and then I'm going to dive into each of them in great detail. And I'm gonna have exercises that you can follow along with. So go back and down below, you can actually download the PDF so you can follow along with everything that I'm talking through. And you can fill out the exercise, and there should be lots of actionable material that you can take away to start working on your numbers inside your financials. So you can have a range of what you think your company's worth now and what your eventual target would be. So we're gonna start with normalized EBITDA. So the normalized EBITDA is a proxy for a normal level of cash flow, regardless of who owns it. So we're getting to that earnings potential. What is the normal level of cash flow, regardless of who owns the company? Then we're going to take and we're going to multiply that by a multiple. And that multiple is a proxy for the number of years based on the risk of that future cash flow. So we're trying to say, okay, if it's a 5 multiple, and this is all just rules of thumb, everybody, if it's a 5 multiple, someone's willing to give you 5 years of cash flow for that business. Someone says, I'm willing to give you a 4 multiple, it's 4 years of cash flow. And it's really based on that risk of that future cash flow. And I'm going to unpack all these, so don't sweat it. Net debt is the next one. That net debt is when we sell a business, regardless to an ESOP or a private equity firm or third-party business or a third-party sale, whatever it is, it's a cash-free, debt-free company. And then you have to provide a normal level of working capital. But that net debt is where you're responsible for paying off all your debt at closing, and you get to keep your excess cash. So you could have negative equity. Back in 2009, when my father and I had the business, $21 million in revenue, loss of $1 million in net income. Had we sold the business at that point in time, we would have owed the bank money. Best places to work and all the Inc. 5000, all that kind of crap. Who cares? Like, we would have owed the bank money. It's like being upside down in your house. And so we have to understand how debt impacts our situation based on the valuation of the company. And you get to keep your excess cash, but the way that a company continues to operate is this working capital, which is a normal level of inventory, payables, and receivables. And that has to stay in the business. And that's why you can provide a cash-free, debt-free company, because you keep the receivables, payables, and inventory inside the business. So that's going to be a lever that we're going to want to absolutely hone in on, because it's going to be one of the fastest ways to generate cash for you, create some discipline around it. And there's a dollar for dollar take home for you when you eventually sell the company, because you can prove what your normalized working capital is. All of that will get you to this market valuation, where the point of this is not to sell the business, but like to actually have a financial model where you can see in every single month or every single quarter and on your annual planning, what is my current market valuation? What will it be in the future? So if you get it, something happens, your industry is hot, or you actually want to sell the business, you say, well, what's it worth to me right now for the cash flow and the time? Okay, and the discounted cash flow. Okay, well, there's a premium in the marketplace going on right now, or I can compare different options regardless of actually taking the company market. And you always have a foot in, or a lens of what's going on outside. So you don't have to engage all the advisors at the exact moment that you're wondering what the company's worth. The goal is to actually know at any given point. And all of these we can find inside of the financials. So we're going to start with normalized EBITDA. So normalized EBITDA is a normal, it's normal level of cash flow a company produces without any weird one-time expenses or profits. The goal is to see how much cash flow the company's operations would produce in the future, regardless of who owns it. If I wanted to buy your company, what's it earning without all the noise? So I'm going to walk through how we find normalized EBITDA. So this is the income statement that we're starting with here. So we start with the income statement, and it's not tied to the cash flow statement, because the cash flow statement takes all of your idiosyncrasies as it relates to your balance sheet and your capital structure into play. We want to strip all that out, and they're trying to use the income statement, which is why the normalized EBITDA is a faulty metric in itself, because it doesn't take in reinvestment into consideration, taxes, and all the stuff that the discounted cash flow does. But just so you know, that any buyer that comes in and buys your company, that's a professional buyer, they're going to look at all that stuff on their own side. So they would be working on the discounted cash flow to say, okay, how much rate of return do I need to by buying this company? But as a proxy for conversations, this is what we've got right now, is normalized EBITDA. And it starts with the income statement. Well, before I go to that, so when we look at the income statement, where does it come from? Well, it starts with revenue. Then we have gross profit after our cost of goods sold. Then we have net income after SG&A, overhead, OPEX, whatever you want to call it. And then we get to this EBITDA. And EBITDA is earnings before taxes, depreciation, and amortization. Oh, I forgot amortization there. It's before that. That's what EBITDA stands for, earnings before interest, taxes, depreciation, amortization. Because the way I like to think about EBITDA as a metric is, if you were to buy my house, do you care if I've got a 15-year variable interest rate mortgage or a 30-year fixed? No, that's my problem. So your whole accounting structure of how you're dealing with depreciation, accelerated depreciation, as a note, when you sell a business, depreciation, it's called depreciation recapture, and it's taxed as ordinary income. It's a big deal. So all of these, the taxes, depreciation, amortization, and interest would be very unique to every single corporate structure. So we're going to strip that out. So we go from net income to EBITDA. And your income statement, it's just a math equation that you can actually calculate out in most accounting systems. Then we get to normalized EBITDA, which is the number that we're going to multiply. I had someone I worked with where they had a very large company and they spent 7 months negotiating normalized EBITDA. What is the earnings? Because they're going to multiply a number by it. So it's very magnified if it's not right. So what is that? These are adjustments that can be positive, which are often referred to as add backs, or they can be negative. And the goal is to get to this normal level of cash flow. So we're taking out a bunch of noise, because I always, in all the Vistage workshops that I do, say, okay, everybody, if we were to throw in our net income into the center of the table here, can we tell the story of the business? Like, it doesn't tell us anything, because so many people are playing tax games. So many people have got a lot of noise in the income statement and the expenses. We're trying to strip all that out, because the net income does not tell us the story. So that there's no story here. Over here, this is the story of the business. What did we do? What worked? What didn't work? What was one time? What was not? And it's like the footnotes of your proof. When I sat down and when we sold the business, I went line by line by line by line, explaining what they needed, what they didn't need, and what we did, is not going to continue. And I've now got an example that we're going to go through of this. But the point is, we're trying to get you to be able to prove your story. Every single business owner I've ever come across can tell one hell of a story of where they've been, where they are, where they're going, what worked, what did not work, but they often can't prove it. And we want to be able to prove it, and we want to do that with footnotes. And the best practices are to do this on a monthly basis. So I'm going to start over here first to show you how we arrive at the normalized EBITDA. So right now you can see that we're starting with $1.3 million in net income. And we have all of these EBITDA adjustments: taxes, interest, depreciation, amortization, which totals up to $400,000. And then what we have down here is we have EBITDA, right? So we got rid of these adjustments to get to EBITDA. But then we go down and we say, okay, well, how am I going to get to 2 million in normalized EBITDA? Which is, I'm going to show, and I'm going to break down a bunch of examples and compare two companies in this, is normalized EBITDA. Well, there was all these adjustments right here that we need to quantify. Why were they one-time expenses? So over here, I have an entire list, and I'm going to go on to the next page, and I'm just going to give you all the answers because you can work through this with me. But this is also good to know. You can take this and you can fill this out while you're going. But I think it's better to just tell the story around why each of these is what it is for learning purposes. So, well, before I go up, I'll just explain some of these. So owner salary, consultant, ERP implementations, rent. There's a lot of different things here that are all noise that muddies up the income statement. So when we go down here, what we have is the ability to have a positive, negative, or neutral. And I've got neutral in there just to throw us some curveballs because we're going to go over each of these. So the first one is the owner's salary. So many times that owner's salary, they pay them, these are just, drastic examples, but someone could be paying themselves 75 grand, but market rate is 125. So then you go, okay, well, what's that adjustment? Well, they're not paying themselves enough. If I bought your company and your job, yet you're paying 75 grand for, market comp is 225, my expenses would go up. So what we have over here is a negative on that expense, because what we're doing is we're going to be reducing EBITDA. So the adjustment is we're reducing normalized EBITDA because there's not an expense in the income statement under SG&A for officers' wages. So it would reduce that. And that's a huge kicker for everybody. And again, if you were paying yourself above market rate, like my father was paying himself a lot of money as a salary, that was not the right way to do it for optimal tax purposes, as well as when we did the adjustment, we actually increased normalized EBITDA. And a lot of this is very when there's I'm going to take a pause for a second. So when there's an actual deal at the table, all of this will be done specifically to that buyer. You have a strategic buyer, they're going to cost cut a lot of stuff, hopefully, to maximize purchase price, unless that's not your goal. An ESOP is probably going to keep everything the same. So what we're doing is we're just trying to get the base case on an ongoing basis to say, regardless of who owns this, what will we be able to cut? A consultant over here. So, whether you have an EOS consultant, if you're in Vistage, or if you're working with Ryan Tansom, all of these are costs that you don't need going forward. So if that's $40,000, that would be a positive add back because you're going to increase normalized EBITDA because there's an expense in the income statement that you don't need, because it is up to the buyer whether they want to use these things or not. So, and again, it can be subjective because all of a sudden you get into a deal and someone's going to argue that you've always had this, and then you're going to argue that you don't need it because it's just I don't want to get away from that nuance right now, just to say, well, if someone were to sell this, you could argue that you don't need an EOS implementer and someone doesn't need to be in Vistage, or they don't need to be working with Ryan. Next is ERP implementation costs. So if you are implementing NetSuite or whatever, I've implemented ERP systems. It's a freaking nightmare. And so let's say you had $80,000 that you spent on the upfront implementation costs. That is a cost that's in the income statement. So there would be a positive add back where you'd be increasing normalized EBITDA. The maintenance contract. What do you think? Over here, I put neutral because you're going to need that maintenance contract regardless of who owns the company. In a strategic buyer, when we sold it, they didn't, because they had the same one, but we're not at the strategic transaction lens yet. So we are looking at this saying, well, that's going to be needed no matter what. So that is neutral. And that's no effect on normalized EBITDA because the cost is going to stay there. A client project, large one-time non-reoccurring client project. So what I mean by this is, my favorite example is, so let's say it's $200,000. I had a home remodeler I was working with, and they would get commercial roofing leads because one of the partners was actually an attorney in the commercial real estate space. They were a residential home remodeler. So they would get the lead, they would hand it off to someone else to collect the commission. Of course they're going to do that. Why wouldn't you do that? Because if this situation, you got $200,000 in gross profit, well, the reality is if we bought that company, we're not going to assume that continues if that partner goes away or if it's not their line of business. So we're going to reduce that normalized EBITDA by the amount that we got from that project, because it's not expected to go forward. Because if we times that by 5, oh my God, now we're sitting at $1 million that why would we pay $1 million for something that's not going to continue? Then we go on to rent. So the owner of the business and also owns the building, and they're paying themselves 10 grand above market rate, and that's per month. So, I got a couple numbers here. So this is correct. So let's say they're paying themselves 180 grand above market rent, which ends up being, that'd be like 15 grand, something like that. Okay. Not going to do back of the napkin math right now. So if we're paying ourselves more than market rent, if we bought that company, we're not going to pay a premium and above market rent on our building. And what the person's doing here, whether they know it or not, is there a capital allocator, and they're suffocating the business's cash flow by 180 grand to allocate capital to real estate. Real estate's probably getting a 7% return. Their business should be getting a 20% return. So whether they know it or not, you're making that decision. But this happens a lot. So what we would be doing is we would be reducing that. We would be increasing the normalized EBITDA because that expense line in rent is higher than it should be. So EBITDA is going to grow. Over here, employee salary, family member, not active in the business. I'm getting 401k matches and got health insurance, right? All of those costs would be positive because we have costs in the income statement that are not there. So it would be an add back and it would be increasing in value. Then we go on to a recruiting firm. So new high-level executive, so we'll call it C-suite. Well, that recruiter is going to cost 70 grand. And it's going to be positive because you can very clearly argue you're not going to hire a bunch of CFOs all the time. You're going to hire one. It's going to be an add back. And so it's going to be a positive and it's going to grow the EBITDA. If you had to have a recruiter on staff to constantly be recruiting for your business, then it would be a normal operational expense. As you start to see, this is so there's so much common sense behind this, and it's going to be 85% accurate until there's a deal at the table, but that doesn't mean we shouldn't track this. Legal bill associated with a one-time acquisition. That legal bill, regardless of what type, if it's one time, it's positive, which would increase the normalized EBITDA. Severance, $30,000. Severances can increase the normalized EBITDA. You're not going to have to do that all the time unless there's an ongoing trend of severances that you have turnover that's very predictable. Again, you start to see what's normal. CPA audit, regular and annual, neutral. So this is not going to affect it at all because you're going to need an audit all the time. One-time acquisition integration costs, $100,000. New logos, you're going to have to rebrand, integrate the systems. That is a positive because you are increasing the expenses, but you're not going to have to do that all the time. Unless you have acquisitions as part of your growth strategy that you're trying to show in the future earnings, you're going to be doing acquisitions all the time. You might have, I've got a client that's a 30% compounded annual growth rate, but 10% of that's coming from acquisitions. That's not one-time expenses then. Those costs have to be accounted for. We're assuming here that it's just one time and there's a one-time acquisition. So over here, the adjustments are $300,000, which gets us to the $2 million normalized EBITDA. I hope that this helped you better understand how normalized EBITDA tells the story. So think about this. If you had footnotes where every single month you were showing what normalized EBITDA was, because in real time, while it's fresh, you're saying, well, that's a one-time, that's a one-time, that's a one-time. If someone called you with an out of the blue offer and you could pull up the trailing 12 months of EBITDA or the last 3 years and you could prove every single month, oh my God, the power is insane. Let alone next level is budgeting out normalized EBITDA. So if you're budgeting the way you should be in a month by month, year by year, month by month, line by line forecast, you could actually budget out what would be one-time expenses to budget out future normalized EBITDA, which I have worked with plenty of clients to do, and that's how they actually can see their valuation into the future. Couple notes about this. This misalignment of what really matters, the net income versus normalized EBITDA, is where I think most conflict comes from. When someone says if I were to ask you how well you did last month or last year, so many people pull up net income or revenue, and I'm like, I just don't care. First of all, if you invested that a ton of money into the business last year, your net income is going to be lower. Well, what if you actually did all these investments and your normalized EBITDA actually grew? Well, wouldn't that be nice to know? So this normalized EBITDA is what we should be tracking. And then I also have seen so many people where their comp plan is tied to net income and everyone is incentivized to not invest in the business. Like, it's so dysfunctional. All of the arguments come across this, which is why we need to zoom out and think about this like an owner to say, well, we're reinvesting in the business. The better question then is, as an owner, how does that impact your cash? Because all of these things require cash, but I'm going to show you they're going to de-risk the company and you're going to grow your multiple and grow your valuation. So we want to incentivize people to grow the value of the company. The better question is, can you afford to do this as the owner? So if you can't afford a $70,000 recruiting fee, well, right here, because you need the cash, then it's more of when can you afford that? And to know it's a normalization and it's not, who cares about net income? It's about your cash and is the company growing in value? So then I'm going to move on to then the multiple, where the multiple is a proxy for the number of years of cash flow based on that future risk. So now we've done all the due diligence to say, okay, here's my normalized EBITDA. What number are we going to multiply that by based on the proxy for the number of years that someone's willing to pay based on the risk? So here's where we go next. The multiple is driven off of the owner's utility, the discount rate, but I'm going to show you how this all ties together. So the multiple, if there's one thing that you take away, the more sustainable, predictable, and transferable your cash flow is, the more the company's worth. We have to calculate the normalized EBITDA, then we need to identify what is the risk of that cash flow. This is where due diligence comes in, and everybody's always trying to assess risk their own unique way. I'm trying to give us a rule of thumb and a best practice on how to think about this without having to sell, so you can be a capital allocator and figure out what should I invest in, what's going to be my return. The multiple, the way I like to think about the cash flow is I love the real estate examples and analogies. So if we had two houses, one on the left here is worth $250,000 and the one on the right here is worth $500,000. Well, why is that? Well, they have the same amount of bedrooms, bathrooms, yard lot size. This one comes with the squatter. That's why it's worth less. No, this one over here is walk-in ready. You could grab the keys. Well, let's see if I can draw a key here. You can grab the keys, that's a terrible key, and live a great life. How does that relate to business? Well, walk-in ready is sustainable, predictable, and transferable cash flow. I want to be able to grab your cash flow and take it. So everything that we're doing, every investment should make it more walk-in ready with more sustainable, predictable, and transferable cash flow. So what does that look like in a set of financials? So over here, and I'm going to keep unpacking these case studies. We have Advanced Solutions, and then we have Rockin Times. This is a trailing 12 months, so a TTM of normalized EBITDA. Well, what we can see then, and because if someone's tracking this into the past, that both of them ended up about a $2 million normalized EBITDA. But look at this. If we were to look at the past, Advanced Solutions is like an EKG. I mean, it's all over the place, but this one's going up and to the right. So what this means is if we were to like actually buy this company with debt and have a debt service in there, how confident do we feel about that? How confident we feel about the sustainable distributions? Not very confident. So over here, we would value this one more and it would have a higher multiple because it's more walk-in ready. And I'm going to now break down how the math is actually calculated for the multiple, but then also what you can do to actually materially impact that multiple. So that multiple is created, it's based off of that discount rate that I talked about in the owner's utility lens. And it's based on the return an investor needs, but the key takeaway, it's the inverse. It's the inverse of the multiple. So we're going to take one. Oh, you're going to get the black. 1 divided by the discount rate will give us the multiple. But we have to figure out, okay, the discount rate. Again, go check out the owner's utility lens if you want more information on this. I'm going to give a flyby of this. So these first 3 are published every single year. Risk-free rate is a 10-year treasury. Time of the recording is 4.7. And what we're doing is we're stacking on risk to figure out what return do we need based on the risk. And so if the 10-year treasury is technically risk-free, again, there's a whole lot behind this, which is if the government prints 8% a year, that's not risk-free because they're debasing our money. But this is how all valuations are calculated at the moment. Say, okay, the cost of money is 10-year treasury is 4.7. We need more return. So we're going to stack on the S&P 500, which averages, what is that, around like 11%, 12%. And then we stack on, well, it's a smaller company. It's privately held. It's less, the cash flows are smaller. It can't weather storms as much. And it's a privately held company where I can't trade all the equity just like I can on a public company at Charles Schwab. So we're going to add more risk. So we're adding each of these together. And then the industry risk is, call it like SaaS versus manufacturing. And there's different risk profiles because of the different CapEx and how fast they can scale. But where we get to this is this company specific risk. Look at that, 2 to 40%. And that is based on, the 2 to 40% is based on this. We're quantifying advanced solutions risk. But how do we actually quantify this? It is based on, I'm gonna skip ahead a slide for a second and then go to the next one. It is based on these value drivers. Ken Sangenario created something called the VOP, and he talks about these 8 drivers. You might be looking at the value builder system, and there's a shitload of these tools out there. What's the risk of my operations? What do I work on next in order to actually become a better company? I think you can actually apply your common sense to say, is this investment going to create more sustainable, predictable, transferable cash flow? Okay, well, if we had 2 companies that, the Rockin Times and Advanced Solutions that both had $10 million in revenue and $2 million in normalized EBITDA. Well, what would be the factors that would be different with them? Well, we could go down here and say we have, let's go like this. Leadership, planning, financial, sales, marketing, ops, people, legal. These are necessary no matter what company we have. Over here, we have leadership is growth minded and strategic. Over here, they're low performing. They're B players and they need to be told what to do. Formal strategic plan. Over here, goal-based setting is just a VTO. It's not actually a strategic plan. Financials, they have a 3-statement model. Over here, they are useless and bad data. Sales and marketing are both repeatable, consistent, data-driven, and focused. Over here, there's no visibility into the forecast. Operations is systematic and streamlined versus chaotic. Amazing culture versus toxic culture. And then legal documentation is clean and accurate versus poor and no documentation. These are just some examples. There's a lot of different, every private equity firm is going to have their own due diligence checklist. Everyone's going to have a figure out their own way of assessing your risk. Little side note on the strategic transaction value. ESOPs are mainly financially driven valuations. They don't have as much say on the operations. They're just looking at the predictability of the cash flow. A strategic buyer is going to be very scrutinizing of how well your operations run. And what I want you to do now is to take an idea of, okay, if I had each of these 8 areas, how sustainable, predictable, and transferable is each function. So 1 is a not at all. So not at all, like it's terrible. And 1 is best in class. So if you went over here and we said, okay, of your different, if planning, so think about it like this. If you fill this out, and I'm going to show you how you can get a rule of thumb on a multiple from this, is if you can't send me your formal strategic plan, not your VTO, like we want to be 20 million. Got it. I want to know product market fit. I want to understand the total addressable market, like a full strategic plan that you can send me. Well, how are we making decisions about where we're going with our product and service? Leadership. Do we have rockstar A players? Are like how are they actually as thinkers and doers? And then sales. Do we have repeatable, predictable, transferable sales that we can show the customer acquisition cost? We can show the repeatable sales funnel. And then marketing. Do we have data-driven marketing? People. Do we have a succession plan for the different people? Cross-functional training. Operations. Do you have an ERP system where you can see your workflows? You can see, budget to actual. You can look at your inventory levels, like how well are your operations systematized. And then finance, do you have a 3-statement model with an actual forecast? And then legal, do you have clean legal history? Each one of those, I'm just giving you the highlights here, but you can go through and then say, okay, well, in people, we might be a 6. Planning, we might be a, what's that? 1, 2, 3, 4, 5, 6, well, I'm sorry. So this is a 1, 2, 3, 4, 5, 6, 7. So if this is a 4, what we're doing is we're just going through and you're checking as a gut instinct. And I highly recommend you go through and you talk to your, every one of your functional leaders is going to argue with each other about how, sales is going to think you're great. Finance might think they're terrible. And it's just a way of synthesizing the truth. But what we can do with this is we can actually go to then, what is your range of multiples? And then I'm going to snap together and show you the advanced solutions and Rockin Times and how both of their risks profile will result in a different valuation. And the multiple here, let's say so your industry range, let's say it's 4 to 6. And where you get this, so I would talk to maybe a broker. Let's give you some better handwriting. A broker or investment banker. Investment bankers are for higher or bigger companies and bigger deals. Your industry association. You can actually talk to your friends if you want. There's something called Pepperdine. Capital Markets Study. And they have a great set of data. It's like a 125-page report every year that says, okay, based on this industry and this size, here's the range of multiples. Every quarter on my podcast, I have Jeff Butner from Butcher Joseph come in and talk about, they get a bunch of data it's proprietary data that they get from private equity firms. But in professional, in professional services, let's say you get a 4 to 6. That's the range. SaaS, it might be 8 to 12. I mean, we're trying to get a range here. And you say, okay, well, my value driver score, let's say it's 35. So I went through that circle up here and I got a 35. Well, if you divide 35 by 56, which is the total amount of points, you get 62.5%. So the 62.5, here's whether you like this math or not. So here's how I like to think about it. Well, 62.5 is slightly above, it's like, 5's in the middle, it's above and north of 5. So let's say we go, okay, we're going to say we're a 5.5. We're going to take 62% between that range, and we are at 5.5. We're not worst in class. We're not best in class. We got some work to do, but you're just getting a rule of thumb. So that way you don't have to go through a $40,000 valuation or whatever. You're just getting a baseline. As a note too, this is a plug because I've got these guys from BizVal. They do a discounted cash flow valuation, and inside of that, they also have a multiple valuation. It's like $1,000 or less or something. I don't know. It's somewhere around that range. Crazy. It's one of the most useful valuation tools I've come across. But somehow we got to get this range. And what this does, so I'm going to go back up here. Check this out. So here we have 2 companies, Rockin Times and Advanced Solutions. So we are going to look at the discount rate. The discount rate over here is 15. Oh, get rid of that. Do this. 15%. versus 20%. And that is because advanced solutions is more risky, right? We saw their wobbly we saw this and say, well, it's more risky. And it's also more risky because of this. And so now we're quantifying that, say, oh, well, okay, let's say we have a 20%. And again, this is not perfect science, but what we're doing is we're trying to say we have 20% and 15% because of the risk that we've identified. Both of these companies, I'm going to walk through you line by line, so just bear with me here. Both of these companies have 10 million in revenue and a net income of 1.3 million bucks. Their normalized EBITDA is 2 million each. And what we're going to do is we're going to take so right here, 1 divided by 20. Oh, shoot. I have my old math in here. 1 divided by 15% equals 6.6. So that is where the multiple comes from. So now we have some logic behind the multiple. We say, okay, well, it's less risky. So we have 1 divided by 15% equals 6.6. And you go over here. Oh shit, I'm so sorry. I forgot. I updated some of the math and it's a little bit wrong. So we're going to take 20 here. So bear with me on this. So 1 divided by 20 equals 4. So we have a 4 multiple that we got from that discount rate. And that discount rate is based on the company specific risk and the buildup. It's the buildup of everything, and then we get into that company specific risk. Just to take a pause for a second, it's all about how risky is your cash flow. I'm just trying to show you where the logic in the marketplace is, and so we can just get rid of all the bullshit. And it's we're trying to hone in on what can I do to grow the value of my company, predict more cash flow, have more sustainable cash flow. If you're going to reinvest in something, let's make sure you get a return. And the cool part here we see is that if we take $2 million here and multiply that by 6.6, gets us our enterprise value of 13.2. Over here, if we take $2 million times it by that 4, what's going on here? That's not right then. 8 million bucks. I'm sorry, you can tell I updated this slide and I'm just going through it on the fly. But all the logic holds true. We now have an $8 million enterprise value. But we have to get down to this equity valuation, which is with net debt. And I'm going to get into that next. Where over here, there was no debt. So Rockin Times has no debt. They have no line of credit. They're not tapping their line of credit. They have no conventional loans. Over here, Advanced Solutions has $1 million. I always like to say it's on their line of credit because of that lumpy cash flow. That will result in the same equity value as the enterprise value because there's no debt. And down here, we had to subtract $1 million to get to 7 million bucks. So what we have as a total takeaway is look at the difference of these two valuations. It's almost double. This company is almost double because of how well their companies run, which equals a lower discount rate, which equals a higher multiple. So we are following this line here to then equal a higher valuation. So if you're investing money into your business, you're actually getting a return. What a concept, right? So we are spending money on a recruiting fee. We're spending money on an ERP implementation. We're spending money. Hopefully you have enough cash flow from distributions for yourself. But how this all ties together is because you should have a more sustainable company going forward, and it should generate more cash flow. Otherwise, why the hell would you do that? And that's where that discounted cash flow comes into play, because The way to actually see the return is actually building out your income statement into the future. So you can see, when am I going to generate that cash? If I hire this director of sales and we have 2 more salespeople come on, we should be able to increase our revenue, which increases our gross profit, which increases our normalized EBITDA, which increases our cash flow. These are just rules of thumb and proxies, because the whole marketplace can't come in and look at your discounted cash flow because they have a whole different corporate structure. So we use these totally not perfect rules of thumb. And again, even on this multiple, you might go through this perfect buildup and understanding the risk. But what if your market's hot? Like this, back to like the market valuation lens, understanding what your range is, and then you might say, "Holy shit, my industry right now is 4 to 8. Maybe I should look at doing something, because I'm going to get a premium based on what I've got the ability to earn and what I currently have." So the way to think about this, the multiple, is there's this valuation teeter-totter, I like to say. And this valuation teeter-totter is if you have a higher required return because you have a shitty strip mall that has no anchor tenants, it's in a dilapidated area, you've got no anchor tenants, no contracts, whatever it is, the value of that asset is lower. So you have to have a higher rate of return. You go down and let's say you have CVS, which is a blue chip anchor tenant, 10-year contract. Your rate of return, I think they have averaged like 5% over the years, because the value of that building is through the roof. Risk return. We reinvest to get a return because the value of the asset goes up. And what I think is the mindset shift here is these are things that reinvest, that cost money to reinvest. Your net income is going to be lower, but a lot of times these are normalization events. So if you're looking at the normalization, which is one of the 2 numbers that we multiply on, then you're like, holy crap, I should be increasing my multiple, which is actually benefiting my return on my target value and my target net worth at a point in time. How are we feeling? You feeling okay with this? Hopefully this is insightful, and make sure that you can stop, rewind. This is the whole point of keeping these recordings out, because it takes time to digest this. I'm a decade into this. Once we understand that normalized EBITDA in the multiple, we have to provide a cash-free, debt-free company. So that's where that $1 million came in with the Advanced Solutions versus the Rockin Times that had no debt. And it's a use of capital, because you might be able to use debt to grow value faster. That's what private equity firms do. They do buyouts. They use debt and then they grow equity and then they sell it. We can use debt effectively. So debt is not a bad thing. And technically debt is cheaper. So if you took out a line of credit and the goal is not to use your funding with the line of credit, because that's like a credit card, but maybe conventional loans, fixed rate. If you're getting if let's say you're at 8% or 9% or 10% of a fixed rate loan, your business should be generating a 15, 20% rate of return, which debt's cheaper. So instead of just using cash or being debt averse, there's a healthy level of debt you can put in. It will be part of that equity valuation equation, but the goal is that you would have a higher multiple, right? So like there should be a return and an interplay between how you're using your debt. So over here, when we have net debt, you have to provide a cash-free, debt-free company. So if you, in an Advanced Solutions situation, they had $1 million in debt and no cash, so their net debt is $1 million. These numbers could be wildly different. You could have $2 million in debt and $1 million in cash. It would end up with the same $1 million. This is really important, because this is why there's so many over-leveraged companies. Joann Fabrics went bankrupt because private equity had over-levered the company. They couldn't service the debt. 97% of their stores were profitable. So they were just over-leveraged. Same thing happened with Toys R Us. I mean, you could go on and on and on about the carcasses from private equity. But we have to take that into consideration. But it should be within your overall owner's goal at understanding how to service the debt in that cash flow statement, service the debt, reinvestment, working capital. which is why we're going to go on to the fourth KPI and the final KPI, which is working capital. This is the gotcha that a lot of people have, and it's the gotcha that you already know is a KPI that should be monitored diligently. But so many times people wake up and they go, "What are my receivables? How much inventory do we have? What are our payables? How much cash we got in the checking account?" It is so freaking exhausting, and I know it from firsthand with a $20 million company with a lot of working capital of inventory, receivables, and you name it. So this is an amazing cash flow lever, and you have to provide a normal level of working capital as a percentage of revenue. And so distribution companies are usually like 15%, call it 15%, roughly range of normal of revenue. That ends up staying in the business. But how we calculate that, and this is an amazing lever to generate more cash without having to grow revenue or increase margins. Let's say over here, I got my notes up over here. Let's say I'm going to show you two examples here to show you the impact of these levers. So receivables, let's say they're 1.5 million bucks. Let's say you collect those on average in 60 days, and there's very legit excuses why we got, a very large company, then they use us. Alan Bolio from ITR Economics, when he was on the podcast, he said that the smart investors are playing balance sheet battles. Who has the money? And we want to do whatever we can in our right without losing the customer to have that money. So let's say we collect that in 60 days, which has an average of $1.5 million outstanding. Let's say payables is $250,000, and we pay those on average of 9 days. And then inventory is $750,000, and we turn that on average 27 times a year. That's fast. That's a fast cycle. And so I want to make sure I'm checking over here. My notes. Yep. So that just as an FYI too, this is DSO, days sales outstanding. This is DPO, which is days payable outstanding, and this is DIO, which is days inventory outstanding. And those numbers are what equal, and it's also called the cash conversion cycle. How effectively are you using your cash, and how much do you have in your bank account versus other people's? So in this situation, our normalized working capital would be $2 million. Whoops. So that $2 million is we're taking the the receivables plus the inventory minus the payables. So you can see then we get to that 2 million bucks. Does that add up? Let's see here. 1 point. Okay. Yeah, sorry, I was right. So you're taking that 1.5 plus the 750, and then you're taking away. I was getting the two different case studies or examples mixed up. So that would equal us this $2 million, and that is an average of 20% of revenue because it's a $10 million company. And so this is why every time I've worked on designing a CEO compensation plan, we want to tie the CEO compensation plan to normalized working capital as a percentage of revenue, because we don't want the payables or the receivables to extend out. We don't want to overdo our inventory. So this is a great metric, because what we can do to generate more cash is, just to show you this example here, where we now have, let's say we take our receivables down to $1 million, because we start collecting our receivables at 36 days instead of 60. And then our payables stay the same at 250. And then we have, at 9 days, and then our inventory at 750 and 27 turns. So by reducing the average days from 60 to 36, we now have a normalized working capital of 1.5 million bucks, which is 15% of revenue. So you just generated $500,000 in cash. You want to maintain your owner's distributions of 30 to 50 grand or whatever. This is a way of skimming off the top without suffocating the growth of the company. So having a discipline to say, okay, well, I want to get people on those collections, or we maybe like what we ended up doing is looking at credit card fees. So like we had allowed our clients where we would pay the credit card fees, and that's not optimal, but we generated more cash. And then we were able to then keep this cycle going. And that was a lot. It was hundreds of thousands of dollars when we were doing it. But what we have here is an extra $500,000 at your disposal. You know, tapping your line of credit, all of a sudden, if you're bumping up to that, this is a way of pulling cash back into your company. You know, another way to do it is extend those payables. You know, and this is where there's the balance in capital allocation of, okay, well, like, why pay everybody 9 days? A lot of people have 25 days or 30 days. And then some people have cash with order discounts. So you're looking at, okay, what's the discount if I get, you know, but what's the use of cash, right? Like, we're always managing cash. That's the whole name of the game. But what's also, not only is this in bank while you own it, you now have 500 grand more in your bank account when you sell, because you have to deliver now 15% instead of 20%. So instead of $2 million stuck in your business, you now only have $1.5 million. So when a company is sold, there's a formula. It's called the net working capital adjustment, where you actually go through and say, okay, based on these days that we're talking about here, here's how the formula is going to work. So you sign the letter of intent, you go through this whole process, and then it's a net working capital adjustment shore up. It could be positive, it could be negative at close based on these numbers. Your goal is to be able to prove these numbers to anybody, because all of a sudden you have like millions of dollars in cash that's been sitting on the balance sheet and people don't know why, or they don't know what your receivables are. All of a sudden there's a money grab for all the extra cash or all of the receivables, all this stuff. But also, because it's a cash-free, debt-free company, they don't want you going and collecting these receivables, offering a 10% discount in the middle of due diligence and then having no receivables at closing, or not paying any of your payables because you're generating cash. So the whole point is, this is an adjustment, and this formula really matters, because the way to think about that working capital is that if you go back to the owner's utility lens, it's this nucleus of what's growing the company. And your working capital, these numbers are going to grow as your company grows, but we want to stay in line with that percentage. So it's a way of looking at it's called a common size. What's the working capital in relationship to the size of the company? Whoo! How are we feeling? The point of all of this is we can track all this stuff in the financials. It's a mindset. We want to take our normalized EBITDA and do this monthly, and then we can track it annually. That trailing 12 months is fantastic. And then we want to be able to forecast it out. But what we want you to do is say, what is your current and your future? What's your current normalized EBITDA? I highly recommend going through and doing this. I mean, if you got the tenacity, 3 years back is always great. I did this workshop where this guy, when I did this this exercise of the normalized EBITDA, his face got ghostly white, and he went through this and he goes, I just left $15 million on the table after selling my company. No buyer is going to tell you that you should have more add backs. And so you want to defend your number to the utmost possibility. And the way to do that is have your footnotes over years. When we sold, I had to go through this and do this all within 2 weeks. I can tell you what, I missed stuff. And I wasn't able to prove things that I wish I would have been able to prove, like all of the entertainment costs that we had with all the sales stuff that we did. There was a lot of inflated costs, but I couldn't prove it. So we want to do that on a normalized monthly basis, put it into our ongoing package, and then be able to forecast that normalized EBITDA into the future. And then we would take that multiple and get a range, and then stress test, if it's a 5 out of 4 to 5 or 4 to 6, and then constantly be talking like, what's going on in the marketplace? Holy crap, it's now an 8. Even though my earnings are still the same, because my home services company is on fire right now, or because, it was e-commerce back in COVID. There's always going to be certain things, there's onshoring now with manufacturing. There will be market things that adjust this 8 up, that decouples it from that build-up methodology, because there's market sentiment. right? So this is an imperfect number. Investment bankers and brokers, it's like the way I think about these multiples too, it's like the drop down in Zillow where like we go to $500,000 houses, 750, million, 1.25 million, or 1.5, 2 million, right? No one goes and says, I want to look for all the companies that are all the houses that are 600 grand. I mean, maybe you do when you get into your refined search, but point is, it's rules of thumb are driving the marketplace, market sentiment, what's going on in the industry, and that will impact the multiple, which is why it's not perfect. And why I also believe when we are justifying what is the company worth to us, we want to know the market lens. So I'm going to jump down here for a second. We want to know the market lens of those 4 KPIs. But what's it worth to you? You know, if you can see your distributions into the future, you're like, I feel pretty good about that. Like, I do believe I'm going to have $2 million in cash and I'm going to have this valuation. Like, keep the cash flow, right? Like, where else can you get that return, especially if you're decoupling your job from the business? And then is there a premium going on right now based on all of the different, types of buyers based on my industry and what my company is doing? And then as we talk about next, what's a buyer, a specific buyer? You might have 1 to 4 buyers at the table, more the better if you're actually going to sell your company. And how do each one of those compare to each other and based on your goals of cash flow and wealth? So these 4 numbers, we want to be calculating them in our set of financials all the time. And then why wouldn't we monitor this? And CEO comp plans should be based on this. We should also be looking at these metrics in our owners meetings, monthly and quarterly, in our board meetings and annual planning to say, okay, if we do this kind of growth, what does that do to the normalized EBITDA? Do we feel like we're going to go from a 5.5 to a 6? How is our net debt going to be? Like, what will our debt and our cash look like in year 4? And then is our working capital as a percentage of revenue? Let's make sure that we maintain that and we get more efficient over time. There was a $500 million company that was in my workshop, and their CEO, 100% of their comp was based on working capital. He goes, he was not a family member, but it was like $1 billion family. And he goes, my goal is to create a cash flow machine for the company or for the family. We just so happened to be in whatever industry they were in. It's that important. And it's also your biggest source of anxiety, where if you step back, okay, well, are we going to have enough money? Well, let's tie all this stuff together. Understanding your goals. And so I'm continuing to plant the seed of the clarify goals, because we had to understand how business valuations first before we can actually get real and realistic with our targets. But we're trying to show here is that we want to reduce our time in the business from 50%. We want to right now. I'm sorry. This is trying to think of how I did this. This is wrong. So don't pay attention to this. What we're trying to do is we're trying to go from operator to owner. And what we're trying to say is, okay, if I'm working 40 hours a week and I want to work 10, that's what I'm trying to get here. And I've been updating some of my concepts. So Clarify Goals module is to come. And by the time you're watching this, you can check it out to see if it's there. Otherwise, it should be there soon. We want to take our cash flow. So we want to be reducing our time, increasing our cash flow, but let's take it through distributions. So we want to increase our cash flow through distributions, which if we can see those distributions, we can increase the confidence, which de-risks the business, which reduces that discount rate, which increases the multiple, which creates a more valuable business. And we can now start to isolate based on these three lenses. How do I go from $5 million to $10 million in net worth? Well, the business is going to be our bridge to get there. And we can start to connect the dots to say, what do we need to do to reduce that discount rate, to increase the multiple, and what will the company be worth in 2030? That's the point of these 3 lenses, is to give us a lens to say, okay, I feel good about this no matter what. So I'm going to reduce that complexity and say, okay, I just want to make sure that I can get my distributions. So our distributions is what we want to forecast out. These are going to be your real distributions. And then how do we if we can predict all of that through the financials and all the best practices that we're doing, we're also going to increase the value of the company. So the more you actually become selfish of collecting distributions and forecasting out those distributions, the more confidence everybody's got. You'll be able to defend your KPIs because you've got the financials. And then when you get to a buyer and you have an out of the blue offer, you're gonna be like, this is what I want, when I want, here's how I can prove it. And we're going to get into that into the next section. So we can talk about specific ownership structures and deal structures and all the nuances. So you can have a layered lens on how to think about business valuations. That was the market valuation lens. I'm going to zoom back out. So as you can see, I'm zooming in, zooming out. And what we were just talking about is the expand knowledge. We have to understand business valuations better so we can decouple our cash flow from our time, getting visibility into our wealth so we can actually create this escape velocity because we are planning for the future. We want to start building a valuable business so we can extract ourselves from operations, so we can create this flywheel and this momentum, and we can be free regardless of whether we own the company or not. I'm trying to think if there's anything else I missed. The point is independence. Let's do whatever we want. That's why we took all this risk. I think as a final note, because I didn't cover those little graphics here. Right here is this trade-off where if we're trying to increase the multiple, this is the decision tree that you're all working on. Should I distribute my cash or reinvest it? If I reinvest it, let's increase the multiple. And if we grow that multiple, let's optimize our working capital. And then we can optimize our debt as it relates to, should we take on debt? Should we keep our cash? This is the flywheel that is the nucleus of a business. And we want that going forward. And that should then accelerate our flywheel that we're working on here. And the reason that we're doing all this first is understanding this, clarifying our goals, because as we get to phase 2 of build a valuable business and then elevate, we can hand off a baton to our C-level suite because we have an actual playbook on how it ties to our goals, to rates of return, time, cash flow, wealth. And we actually have a way of measuring and monitoring whether we're on track or off track because we know the stuff, but we also have built out the systems and the machine in the build phase to do so. To more independence, thank you for sticking with me. I hope this was valuable. Share this with a friend. Otherwise, reach out if you got any questions. See ya.